Hello everyone and welcome again to the second video of the series on the tax equity financial model template. In this video, we're going to see the three main options that you can choose from before committing to a final purchase. Let's gonna get started. So here on the bank run templates landing page, you can go to templates, then price and paid templates. And if you want to reach out to the tax equity financial model, you just scroll down until you come here. So this is the tax equity financial model. You click on it, and I'm going to go to the tax equity financial model homepage. And as you can see, there are three main options that you can choose from: the dates, the scenario manager, and the commercial structure. We're going to go now to the Excel so we can see what the differences are between each one of them and what makes more sense to you. So here we have our flagship template, which has flex dates, the scenario manager, and the partnership flip commercial structure. Let's go and start showing to you first what the difference is between the flex dates and the fixed dates. And to do that, we're going to go to the input sheet and to the first section of this sheet, which is the timing. That's how you're going to set up your timeline for the whole model. So what is flex date? Flex date simply means that you can choose the periodicity of each one of the phases of the projects. In this case, we're going to have the construction and operations phase. And the periodicity is on cell M8 and M9. So for the construction phase, you can choose the periods as monthly, quarterly, half yearly, and yearly. And for the operations, you can choose from quarterly, half yearly, and yearly. There are three more inputs that you have to provide for a timeline. The first one is the model start date, and this is a quite important date in the model because that's the date that every single cash flow in the flex date template is going to be evaluated at. Then you have to set up the duration of the construction phase in months and for the operations in years. And that's it. So let's see how the timeline works by going to a sheet that has one. So we have here the construction sheet. And as you can see, we bring here all the inputs we provided to the template, operating years, the start and end dates for the construction and operations, and the model start dates. And as we said in the input sheet, for the construction phase, we're going to have each one of the periods set as quarterly, as well as for the operations phase. So you can see that each one of the periods for the operations phase also has a quarterly periodicity. I'm going to change that for you so you can see how that works. So I'm going to go back here to the inputs. Now I'm going to change here the periodicity for the operations phase from quarterly to yearly. You can see that a flag has been raised for the macro. We have to rerun the macro when you change the periodicity of the model. We can learn more about this later on, but I'm going to go back and you can see that for each one of the periods during the operations phase, we have it on a yearly basis. So that is what the flex date is. For the fixed date, none of this is possible. And we're going to show you right now how the fixed date timeline works. Here we have the fixed date template. And in the input sheet under the time section, you can see that you only have to provide one input, which is the durations of the operations phase. And that's because how the timeline in the fixed date is set up. The assumption in this case is that each one of the periods of your timeline will have the same length, and the construction phase will fall under construction period number 0. That means that all your capex is going to be considered as the overnight costs, and your cash flow is going to be evaluated at the end of the construction period. One important thing to notice is that most likely you're going to use each one of the periods on a yearly basis, meaning that each period has exactly 365 days. And that's the main difference between the two models, because on the flex date, your cash flow would be evaluated one day before the construction starts, while in the fixed date, your cash flow is going to be evaluated at the end of the construction phase. And because of this, the model will produce different results. They're both correct, it's just a matter of assumptions, because of the fixed date, we're using the overnight costs, assuming that we're going to evaluate all your cash flows at the end of the construction phase. That's it, nothing more. Let's gonna go now to the second option that you can choose from, which is the Scenario Manager. The Scenario Manager is a very useful tool that allows you to test up to 15 upside and downside cases by changing up to 24 variables or inputs in the model. You can find it under the MACRS and Scenario sheet and Macro Manager section. Here you have the 15 cases or scenarios and all the variables that you can change. You can change variables such as the production, the capex, the opex, or revenues. You can also change how you want to set up your debt structure, the equity, the shareholder loans, the tax, and the tax credits. In this example, I have tested a few different parameters for different cases. In the case number 2, I'm checking how the IRR of the project will change if we were to have a different payment schedule, or if we were to change, as in case number 4, the type of tax credit option. Once you are done with the Scenario Manager, you just have to come over here and run the scenarios. The macro is going to run for you every single scenario and present the results under the results sheet. Scroll down. And in the section Scenarios Results or Scenario Graphs, we're going to have all the main outputs of the model, such as the equity, NPV, and IRR, the project NPV and IRR, the minimum debt service covered ratio, the date when that happens, the cash flow available for equity, and any warnings and checks for the model. Then, on the right side, you have 4 graphs that you can also compare each one of the results for each one of the cases you have changed. If you want to see the full result for a particular case, you just gotta come here to the macro. Under cell G19, you can change the case. And then the full model is gonna be set to run case number 5. That's very simple, nothing more. So this is the Scenario Manager. Let's gonna go now to the partnership flip commercial structure. If you have opted for a template that comes with the partnership flip, you're gonna find all the inputs under the input sheet. Then you're gonna come to the financial parameters section, and on the bottom of it, you're gonna see the flip targets. I'm not gonna go into the details of what the partnership flip is, but you have 2 entities in this deal, the tax equity investor and the developer. For the tax equity investor, you have to come up with the target IRR, and the same for the developer, where you have to provide the developer target IRR. Then you have to provide 2 more parameters, the share of the equity for the tax investor and the share of the project cash flows pre-flip to the tax investor. That's it. Then all the calculations are going to be performed under the return sheet, where you have a full section that calculates all the returns for the tax equity investor and the developer, and the results are going to be presented under the results sheet and returns. In this example, we have that the flip year is on year 3. The tax equity investor is going to have an IRR of 16.57%, and the developer will have an IRR of 61.83%. This is how the partnership flip works in the tax equity template. That's it for today. In the next video, we're going to see how to fill out the input sheet from beginning to end. I hope to see you in the next one. Bye!